Jim Rickards is a U.S. financier well known for his sensational announcements on the price of gold, in particular. Recently, he announced that an ounce of gold that is worth $1,800 or €1,600 today could rise to $10,000 in the coming years. Does this mean that gold will be the only refuge from countless government bankruptcies around the world? Does that mean that all the gold owners will have made their fortunes? Does this mean you have to buy gold? To explain how Jim Rickards can arrive at such predictions for gold, we have to go back to 1925, when England failed miserably when Churchill re-established the gold standard for the pound sterling. This unfortunate experience plunged England into an unprecedented economic depression. Come on, let's go. In 1925, the price of the pound sterling rose against the dollar, and the British dreamed of a pound sterling convertible into gold that would restore London's prestige as a world's financial center with all the advantages that go with it. On May 5, 1925, Winston Churchill restores the convertibility of the pound sterling to gold. Each pound sterling is worth 7.32 grams of gold, as it was before the First World War. World capital returns to London, public finances are put on a sound footing, and initially, everything is going well. The problem is that in 1925, the British came out of the First World War with a much less competitive economy than in 1914. On the other hand, neighboring European countries such as France and Germany had very cheap labor because their economies were in ruins. This convertibility of the pound sterling into gold leads to an over-evaluation of the British currency by about 10%. This may not seem much when one considers that the over-evaluation of the euro between Germany and Italy is estimated at around 30%. Little by little, what had to happen, happened. Britain entered an unprecedented economic depression. Reasons for the depression from 1925 to 1929. In order to understand this, it is necessary to remember two key economic concepts. Firstly, fixing a currency's convertibility to gold means establishing a fixed exchange rate against gold. The exchange rate defines what is produced in the country or abroad. Second, it is important to remember that the exchange rate of a currency is used to decide what is going to be produced inside or outside the country. If the exchange rate is high, it will be easier for people in the country to buy what is produced abroad. If the exchange rate is too low, goods and services produced in the country will be more affordable than those that can be bought abroad. So when you tinker with the exchange rate, you give a long-term impetus to industrial development in the country. Recession through money. Since Churchill set the convertibility to gold 10% too high, that which was bound to happen happened. Phase 1. Artificial money boost. Initially, purchasing power in the United Kingdom increased as foreign goods were cheap for the British purse. Local economy goes into crisis in the face of foreign competition. Secondly, it was local industries that went into crisis because they could no longer find enough customers internally, either at home or abroad, because the exchange rate was unfavorable to them. Phase 3. Recession settles in with rising unemployment and the atrophy of the local economic fabric. Finally, economic growth disappeared, giving way to long and painful recessions. Because the British were buying French and German rather than English, the economic fabric of Great Britain unraveled to the point of increasing unemployment and poverty. There are strong similarities with the euro, which locks the exchange rate between all countries in the zone. It is more or less the same thing that happens in Europe between the countries of the South and the countries of the North. The Italian economic fabric is atrophying in favor of the German economic fabric, and imbalances are growing, causing the ruin of savers in the North and ruin of the businesses in the South. In conclusion, nothing new. Manipulating the exchange rate upwards ends up destroying a country's economy. For those who wonder, a forced underevaluation of the exchange rate is not a better idea in the long run, but that is another matter. What's that got to do with the gold, you ask? If Churchill had listened to John Maynard Keynes, who shouted loud and clear through 3 articles at the time that it was necessary to put a much lower convertibility to gold of the pound sterling, but at the right level of competitiveness for the British, all this would not have happened. In times of monetary crisis, as is the case of today, restoring a conversion to gold actually allows a new exchange rate to be established before an impartial justice of the peace. When you say, my euro, my pound sterling, or whatever, is worth so many grams of gold, you are exposing your economy to be the adjustment factor if you are not at the right level. If you hit too high when people find out, they will convert their money into gold and go and invest abroad. That's why the United States broke the gold standard with the dollar in 1971. They knew that the dollar's price was worth far less than its guaranteed value in gold. Today's problem is this. In the US and Europe, we finance our lifestyle with debt held abroad. This debt has allowed the West to produce fewer goods than it consumes. Today, there is an imbalance in our trade with the rest of the world. Simply put, it's called living beyond our means. The day our creditors realized this, or at least the day they no longer accepted it, the value of the dollar and the euro will be considerably lower. It is at the end of this process that gold may very well end up at $10,000 an ounce. In an economic context where there is mistrust of the value of money, gold is once again taking its role as a monetary thermometer. Since human beings have blind faith in the value of gold and the quantity of gold is fixed, gold rises when money is mismanaged. If gold prices rise in all major currencies, it means that the purchasing power of these currencies is falling. So the more money you print in an economic crisis, the more gold goes up. But let's get back to Jim Rickards and his $10,000 for an ounce of gold. The math is pretty simple. He makes an indicator that he calls the world monetary base as a sum of the M1 money supply of the world's major economies: USA, Europe, Japan, and etc. Then he assumes that he has 177,000 tons of gold in mineable form. Basically, this excludes gold that has not yet been extracted from the ground and gold that is unavailable, such as treasures hidden in the bottom of the sea by pirates. Then he divides his world monetary base by the number of tons of gold and brings it down to the weight of an ounce, which gives him $10,000 in 2019. I might as well tell you right now, this calculation is wrong. First of all, the principle of a world monetary base is interesting, but it neglects all the distortions that can exist between the different economic zones. Secondly, we don't really know how much gold there is on Earth. To be more precise on this point, to make a meaningful calculation, we need to know the quantity of gold in the form of coins and ingots that would be ready to circulate if the financial system were to be overhauled, and we would also need to know the quantity of gold that could be transformed into coins and ingots. And yes, the day the monetary system takes gold into consideration, it is likely that jewelers will look at their gold stock differently. It will be the same for all family jewelry in one form or another. In short, we have no idea what these two indicators are. However, you must be interested in his calculation. If one is objectively unable to solve this calculation, one knows that it is indeed this ratio that would be established in favor of gold in the event of a flight from money. Therefore, the right question to ask is not whether the calculation is wrong, since it is a certainty. No, the right question is whether the reasoning is right. And here I am tempted to say yes. As far as stocks are concerned, the case is interesting because I'm beginning to see a little more clearly. The worse the news is for companies, the higher the stocks go. This seems counterintuitive unless you consider the following old stock market adage: when liquidity rises, there are geniuses everywhere. Put another way, Charles Gave would say the question is whether there are more fools than money or more money than fools. Clearly today there is much more money than fools. Central banks and governments are literally flooding the world with money. Until the COVID crisis, only the financial sphere was affected by these currency injections. But now, since the COVID crisis, the currency helicopters have taken off and money is starting to be sent directly into the accounts of companies and even individuals. In a world where the economy is depressed and in a world where mistrust is taking hold of the currency, the equity markets act as a reel. If you are given money and if you don't know what to do with it, buy stocks in multinationals. There will always be something left, right? It's an interesting thought that comes down to putting stocks on an equal footing with gold. Would stocks have become a safe haven? In a way, yes. But like gold, the interesting thing about gold is that its fundamental value is zero. Gold is an IOU to the world. When you own $1, it is the United States that owes you $1 because every American recognizes the value of $1. Then, with gold, it is humanity that owes you a debt because every human being recognizes the value of gold. The gold is therefore related to the quantity of money. This makes sense. As far as stocks are concerned, the fundamental value of a stock corresponds to the economic potential of the company corresponding to it. No one wants a Boeing stock at the moment because everyone has understood that the aviation sector is brain dead. So any market movement that moves away from the fundamental value of companies in a sustainable way is a bubble in nature and not a store of value. On the other hand, as Keynes said, never forget that the market can remain irrational longer than you can remain solvent. It is useless to bet against the market. Tesla short sellers have learned this lesson the hard way in recent weeks. That's why I think the markets will continue to rise, but I won't buy stocks. I won't sell short either. Remember, it's more important not to lose money right now than to try to make money. On that note, see you soon for new videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.